Hey everyone, welcome back to Corporate Decoder, the place where we decode SEC filings to show you what companies are really up to. Today we're diving into HF Sinclair's latest report, and let's just say they're making some big moves with their debt. This is HF Sinclair, a company we've seen before, and they're letting us know about a pretty significant financial maneuver they're undertaking. They're calling it a redemption of their notes, which is essentially a fancy way of saying they're paying back some of their IOUs early. You know, HF Sinclair, they're traded on the New York Stock Exchange under the ticker DINO. They're in the energy business, refining and marketing oil products, and now they're also involved in renewable fuels and other things. Now for the main event, HF Sinclair is basically saying they're going to pay off all their 2026 senior notes and also their 2027 senior notes. Plus, they're doing the same for similar notes issued by their subsidiary Holly Energy Partners. These are basically loans the company took out. By redeeming them early, they're saying they have enough cash or can borrow money on better terms to get rid of this older debt. Think of it like paying off your credit card early with a lower interest rate loan. They want to get rid of these older, maybe more expensive debts. So how much is this costing them? For the 2026 notes, they'll pay back the face value, so 100% of what they owe, or they might have to pay a bit extra, a make-while premium, if the original loan agreement says so. On top of that, they have to pay any interest that's already built up but not yet paid. This interest part is important. It means they're settling up all the interest that's accumulated until the day they officially pay off the debt. This whole debt paying off is planned for August 30th of this year, 2025. So they're acting pretty quickly on this. They've attached a press release to this filing, which is basically their official announcement to the public about this plan. This is how they formally communicate these kinds of big financial moves. Now, you might be wondering why they're doing this. Well, by redeeming these notes, HF Sinclair is likely taking advantage of a more favourable interest rate environment. This means they can borrow money at a lower cost than before, saving them money in the long run on interest payments. It's a smart financial move if they can afford it, and it signals that they have a healthy cash flow or access to cheap financing. And look, the report is signed by their Chief Financial Officer, Atanas H. Atanasov. This shows that the company's top financial mind is overseeing and approving this significant financial activity. It's a signal of confidence from the very top. On a broader level, this move suggests HF Sinclair is strategically managing its debt. They're cleaning up their balance sheet, which can make the company look more attractive to investors. When a company actively works to reduce or refinance its debt, especially older, potentially higher interest debt, it often means they're focused on improving their financial health and boosting profitability for the future. It's like decluttering your house to make it more appealing and manageable. However, as with any debt management, it's important to consider the source of funds for this redemption. Are they using their own cash reserves, or are they taking out new loans? The filing doesn't go into that specific detail here, but it's something investors would want to understand. If they're using cash, it means they might have less liquidity for other investments or operations. If they're taking on new debt, they need to ensure the new terms are truly better and that they can comfortably handle those payments as well. The fact that they're redeeming these notes well before their actual maturity dates in 2026 and 2027 indicates a proactive approach. It's not just about paying bills when they're due, but about optimizing their financial structure. This can lead to lower overall interest expenses, which in turn increases net income. For shareholders, this means more profit potentially being available for dividends or reinvestment in the business. It also reduces the company's financial risk, making it less vulnerable to interest rate changes or economic downturns. So what's my take on all this? Sinclair is showing us they're a company that's actively managing its finances and looking for ways to become more efficient. By paying off these older debts, they're likely aiming to improve their financial flexibility and reduce their interest costs. This is generally a positive sign. It suggests they are confident in their future earnings and their ability to manage their financial obligations. However, it's always wise to keep an eye on the overall debt picture. While this is a good move for specific notes, we want to see the full financial picture to understand their total debt load and how this fits into their overall strategy. Are they reducing total debt or just swapping one type for another? Without seeing their balance sheet, it's hard to be absolutely sure, but this specific action is a move towards financial optimization. The potential risks are minor if they have strong cash flow, but if their operations were to falter, managing these new obligations could become a challenge. Overall, it points to a management team that is focused on financial prudence. Alright, that's our breakdown of HF Sinclair's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.